Hello everyone and welcome back to the channel. Yes, as you can see, we are deep diving into is British American tobacco worth adding to the portfolio, or pretty much known as BATs. So what we're going to do is break down today is what the company actually does. Is the business strong and is it worth adding? Is the free cash flow really good? The valuations using multiple methods, so I'll show you what methods you could use. Wall Street, what they talking about, and the estimates they are basically talking and seeing what the upside or the downside of the company is. And most importantly, like I say, whether it's worth adding to your portfolio today. But please reminder, there is a disclaimer. I'm not an financial expert, so please do your own research. And honestly, just take this as an opinion based because I just want to share what I would do if looking at these companies because most of the companies that we cover are on my wish list. So when I'm trying to learn, I kind of want to do the same thing by allowing you guys to learn. So grab a drink, sit back, and let's get into it. So what is British American Tobacco? Well, we already know its ticker, BATS. So British American Tobacco is a global holding company that specializes in manufacturing and distribution of tobacco and nicotine products. The company operates as a multi-category consumer goods business, offering traditional cigarettes as well as next-generation alternatives such as vaping devices, tobacco heating products, and modern oral nicotine products. So, basically, BAT is a tobacco and nicotine product company all around the world, basically. So they've got an international coverage. The thing is, they're not just a cigarette company no more. They now operate as a multi-category consumer good business. So, as we covered, traditional cigarettes, vaping, tobacco heated, and of course the modern oral nicotine products. The company is trying to adapt because consumer habits have been expanding beyond just cigarettes. Because people want to stop smoking and then they want to transition to vaping because they think that's better, or it just helps them, to quit smoking whatsoever. So they've managed a global supply chain and they sell all these products worldwide. And as we can see, we've got some quick facts. So they are based in the United Kingdom. Tobacco and nicotine products is their industry. So the market cap around when recording this video is 91 billion. It's got roughly 48 plus employees. It was first listed in 1962. Well, what's the information I can get anyway? I might be wrong, but it says IPO 1962. Way, 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 way before I was born. Dividend growth streak 25 years with a 5-year dividend growth of 2% per year with a dividend yield of 5.21%. So straight away you can see this is a huge established income focused company. Now at the time of recorded, which is February the 6th, it was 4,609 GBX, which I think is it roughly 46 pounds? If I do my maths correctly, I think it's 46 pounds. And so yeah, so it's traded quite well. It's up 38.4%. 38.4% a year. Yeah, so that's year-on-year performances. So as you can see, it's quite up this year. So is it still worth investing? So we'll get to that. If you're wondering, oh well, it's up 38%. Have I missed the boat? Well, let's have a look. So I am going to cover free cash flow. So for people that not quite sure what free cash flow is, it is money that the company has left over after it pays for all expenses and any investments it needs to keep the business running smoothly. Basically, a simple way to think of it is like a personal budget at home. Once you've had paid all your necessaries, such as your mortgage, your food, and your bills, and also let money aside for future needs like having a holiday, car, or home repairs, whatever money is left over from that, you are free to spend or save however you like. It is important to understand free cash flow because it has a major impact on financial health of a company and the direction it may be headed in. And as you can see, free cash flow could also be labeled as FCF. So just take a note of that. So FCF is important as it's a good indicator for how well run and how healthy the company is. This is due to potential to grow the business, reduce debt, or pay dividends. Hence, more the free cash flow a company has, then the more they can be more flexible. On top of this, if a company has good cash flow, they can reward shareholders by giving money back through dividends or share buybacks. Share buybacks are usually led to increase the value of the remaining shares. So, British American Tobacco. Right. the free cash flow chart. So as you can see, we are looking at the chart on the slide, and we can see the bats have generated a strong, consistent free cash flow over the past 5 years. Even though the numbers fluctuate a little bit during the year on year, the overall picture is stable. That's exactly what you want to see from a mature dividend company, steady cash flow generation. This stability is one of the main reasons BATS has been able to keep increasing dividends for so long. So as you can see, from 2020 to 2024, it has been going up, and then of course it has dipped a little bit, but I would like to say that's a good, healthy cash flow in terms of the reserves. So if something does go on, we can at least, they can cover anything. They could pay more dividends, or they could reward shareholders with special dividends or buybacks, as we covered. So DCF. So what is DCF? Well, it's a discounted cash flow evaluation, and it's a way of estimating what a company is worth today based on how much cash it is expected to make in the future. It takes those future cash flows and adjusts them to reflect the time value of money, meaning money today is worth more than money in the future. DCF is one of the main methods I use when valuing a stock. I like to use more than one valuation method because it helps me give a balanced and accurate view. By comparing the different approaches, I can take the average and feel more confident in the final result. Because valuations are based on forecasts, please note they are not 100% certain, so to manage this, I create different scenarios for each valuation, best, average, and worst case. Then this helps me give a margin of safety, which is quite good because I'd rather see what's the average and the worst case outcomes so I can see if I'm buying a sensible and safer price. So, British American Tobacco DCF valuation. So, using the worst and the base and the best case scenario, with a discount rate of 7.91% with terminal growth of minus 3.13, the worst case scenario, you can already see British American Tobacco is overvalued at 34%. So there could be a 34% downside. Base case with 7.53% discount rate, terminal growth is 0. Then undervaluation is 13%, so there's an upside of 30% there. And of course, best case scenario, as you can see, is 63%. So depending on assumptions, the value range massively. That's why we don't rely on just one method. So here is the relative valuation, and you can see there's a lot of red. Yes. So this compares back to similar companies using metrics like PE ratios and other industry benchmarks. And once again, we can see these three scenarios. Overvaluation on the worst case scenario is 66%, the base is 61%, and the best case is 57%. These numbers are a lot lower than the DCF values, which shows how different valuation methods can give us very different answers. Now, at the time of recording, please note it was 4,604 GBX, but this is the intrinsic value, so which combines different factors to estimate the fair value. And the intrinsic valuations have come out as following. The worst case is 50%, the base case is 23%, but the best case is 37%. So once again, a very wide range. So what are Wall Street estimates? Well, Wall Street estimates are forecasts made by professional analysts about how much money a public company is expected to earn in the future. These estimates usually focus on expected revenue and profits for upcoming quarters and years. Analysts study individual companies and give their opinions on what they believe the company is worth. Large companies often have many analysts covering them, which can help make an average estimate more reliable. So I kind of use them as an extra reference point alongside my own valuations. They aren't perfect and they can be very wrong, but they give a good idea of what the market is thinking. So, what are Wall Street targets? So, 1 year on, Wall Street is the worst case scenario, is saying there's a 33% downside. The base case, there's only 1% upside, and the highest forecast is 19% upside. So it's pretty mixed, but on the average side, I only see 1% from today's price. So it doesn't really scream strong buy for me. So the overall results, right? So as you can see, the three valuations is worst base and best cases. So what is the attractive price? Well, worst case scenario the average fair value with the margin of safety and the 20% margin of safety is roughly between 2,301 to 1,841, which means it looks definitely overvalued in the worst case scenario. For the base case, for 3,524 with 10% and 20% margin, the current price is still even above the base. The current price is way above the base case fair value, and it's only the best case where it seems more reasonable in terms of the current price outlook. But to be fair, for the fair value of 7,287, but with 10% and 20%, I wouldn't really just rely on the best case scenario. I'd rather see the worst case and the base case also being saying it's undervalued, because you can't rely on everything happening and lining up. Now, I know a few stocks have done that, where like you look at Nvidia, and look at like Meta, Google, all these companies done a massive rise up. They probably just had the best case scenario because of the way the company is. So you do miss out on the good winners, but you'd rather be certain on what you're looking at. Once again, please do your own research. I'm not a financial expert. So what is the final verdict? Well, based on my valuations, based on what I would say, it would be a hold or avoid/hold, because I am not holding at this moment in time. So for me, it's not a buy at this current price. Well, even though it's strong, cash generating company, but at the current price it still looks overvalued compared to a realistic base and worst case scenarios. However, there are still positives, like the high dividend yield, 25 years dividend growth, stable and growing cash flow, strong global plans. So for existing holders, I'll say hold, because it's a great income stock. But for new buyers, I'll probably wait for a better entry. So please make sure to follow out and see if we've got any more stock deep dives, because I'll try and post at least once every week. I am trying to do maybe 3 a week. And if there's a stock that you want me to cover, then of course, comment down below in the comments. And if you did enjoy it, leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.